20 years ago, this company's big idea was written off as a punchline, a fuel cell in a box that even 60 Minutes struggled to make sound believable. Today, it's a $67 billion company that just posted record revenue, and NVIDIA-backed data centers are lining up for its power. This is what Bloom Energy actually builds, how it survived a short seller report that once sent its stock to $3, and why the same stock swung between $40 and $351 in the last 12 months. On July 29, 2026, Bloom Energy reported second quarter revenue of $1,065 million, up 166% year-over-year and 30% above what analysts expected. Earnings per share came in at 78 cents, up 680%, and the company raised its full-year guidance to between $3.9 and $4.2 billion, roughly double last year's revenue. And yet the stock fell as much as 13% right after the print, on worries about margins and a cautious tone on the call. A record quarter that the market still wasn't sure how to feel about, which is the story of this entire stock. Bloom Energy is a publicly traded fuel cell manufacturer, headquartered in San Jose, California, trading on the New York Stock Exchange as BE. It has around 2,300 employees, $2.67 billion in cash on hand, and about $2.5 billion in long-term debt. Its market cap has gone from under $6 billion to nearly $70 billion in a single year, a swing that took the stock from just over $40 a share to a high of $351. At 259 times earnings, Wall Street is pricing in a lot of future that hasn't happened yet. Here's what Bloom actually sells. The Bloom Energy Server, a stack of solid oxide fuel cells that convert natural gas, or eventually hydrogen, directly into electricity through a chemical reaction, no combustion involved. Customers install these on-site, behind their own meter, so they don't have to wait on the utility grid. Early customers were Google, eBay, Walmart, and FedEx, testing the boxes as a curiosity. Now the customers are Oracle, American Electric Power, Equinix, and a $25 billion financing partnership with Brookfield that lets data centers get Bloom's power without paying the upfront cost themselves. Same box, completely different customer. Here's how Bloom actually got here. 2001, KR Sridhar, a former NASA researcher who'd been designing fuel cells to make oxygen on Mars, founds the company as Ion America. 2006, renamed Bloom Energy. July 2008, the first real-world deployment, a 400-kilowatt system at Google's headquarters. February 2010, the Bloom box goes public on 60 Minutes, with eBay, Walmart, FedEx, and Coca-Cola all signing on. July 2018, an NYSE IPO raises $282 million. September 2019, Hindenburg Research publishes a short report alleging $2.2 billion in hidden liabilities. The stock crashes to $3.31. January 2026, a $2.65 billion deal with American Electric Power. April 2026, Oracle expands its contract to 2.8 gigawatts. July 2026, a report alleging undisclosed reliance on Chinese-sourced scandium triggers new securities lawsuits. And by August, Brookfield's financing partnership has grown from $5 billion to $25 billion in 9 months, and Bloom's total backlog sits at $20 billion. So what does Bloom say comes next? For all of 2026, guidance points to revenue of $3.9 to $4.2 billion, roughly double last year. The backlog stands at $20 billion, and the Brookfield partnership alone is now sized for $25 billion of power-as-a-service deployments, letting data centers add power without the upfront capital cost. CEO KR Sridhar has framed the whole pitch around speed. A gas turbine takes 4 to 6 years to permit and build. A Bloom deployment is measured in weeks. The bet is that as long as AI data centers need power faster than the grid or turbines can deliver it, that speed gap is where Bloom's growth comes from. So what's Bloom's actual edge? Speed. Its fuel cells deploy in weeks, not the years it takes to permit a new gas turbine or get a new grid interconnection approved. And in an AI build-out where every month of delay is lost revenue, that gap is the whole business case. No combustion. The electrochemical process avoids the emissions and noise of a turbine, even though it's still largely burning natural gas today. 20-plus years of manufacturing scale that smaller fuel cell rivals like Plug Power and Fuel Cell Energy haven't matched. And now, financing partners like Brookfield willing to fund the boxes themselves, so customers don't have to. None of that is new technology. Bloom has been selling this same idea since 2008. What's new is that the market finally needs it on Bloom's timeline instead of its own. So how does Bloom stack up? Against GE Vernova, the giant of gas turbines, Bloom is far smaller, and its fuel cells are more expensive per kilowatt. But Vernova's turbines take years to permit and build, while Bloom ships in weeks. Against Plug Power and Fuel Cell Energy, its closest fuel cell peers, Bloom is the more established, better capitalized name, with actual blue-chip customers signed. And against the grid itself, still the cheapest power there is. Bloom's whole pitch is that cheap doesn't matter if it takes years to connect. It's not the biggest power company, and it's not the cheapest. It's the fastest one data centers can actually get plugged into today. CEO KR Sridhar put the pitch about as bluntly as it gets. Quote, "Chips without power are inventory, not intelligence." It's a good line for a keynote. Whether it holds up depends on Bloom actually being able to deliver that power at the scale and margin it's now promising. None of this comes without risk. There's the valuation. At 259 times earnings after a stock that went from $40 to $351 and back down again in a year, a lot of near-perfect execution is already priced in. There's the emissions story. Bloom's fuel cells mostly run on natural gas today, not hydrogen. The same, quote, clean energy question Hindenburg Research raised back in 2019. There's an active securities lawsuit filed after a July 2026 report alleged Bloom understated how much of its scandium, a key material in its fuel cells, comes from China. There's the track record. This is a company that Hindenburg once drove down to $3.31 a share, and it took years to recover. And there's customer concentration. Oracle, AP, and the Brookfield partnership now make up an outsized share of that $20 billion backlog. The bet is that the AI power shortage is real and durable enough to outrun all of it. So why does any of this matter beyond one company's stock chart? Because Bloom Energy is the clearest bet in public markets that speed, not price, not even cleanliness, is what wins in the AI power build-out. The bull case, record revenue, a doubling guidance raise, and a $20 billion backlog from Oracle, AP, and Brookfield, all chasing power they can't get from the grid fast enough. The bear case, a 259 times earnings valuation, a live securities fraud lawsuit over its supply chain, and a stock that's already proven it can round-trip from $3 to over $300 and back. If AI data center spending ever meaningfully slows, or if the scandium story turns out to be more than noise, Bloom is one of the most extended stocks in the entire trade. So which is it? The fuel cell company that finally proved its 20-year bet on distributed power right when AI needed it most? Or a story that's gotten too big, too fast, with a securities lawsuit already testing the cracks? Comment your take below.